All right, let's dive right in. Today, we're going to tackle a really important and sometimes tricky part of the tax audit report. I'm talking about Clause 13 of Form 3CD. Now, I know, it sounds super technical, but trust me, getting a handle on this is critical, whether you're the CA signing off on the report or the business owner it belongs to.
So why are we focusing on just this one clause? Well, because this little section gets right to the core of your company's financial story. If you get this wrong, it can seriously mess with your declared profits and, your overall compliance. It's a tiny bit of real estate on the form, but it packs a big punch.
So here's the game plan. We're going to take the official guidance note from the ICAI, that's the Institute of Chartered Accountants of India, and basically translate it. We're turning those dense, technical rules into a straightforward, practical guide that you can actually use. By the end of this, you'll know exactly how to handle Clause 13, no matter which side of the desk you're on. Okay, first things first. We have to start at the very beginning, with the foundation of all your financial reporting, and that's your accounting method. This is where Clause 13 kicks off, and honestly, it's the bedrock for everything else that follows. Under the Income Tax Act, you've really got two main options. First, there's the cash basis. This is the simple one. Think of it like your bank statement. Money comes in, you record income. Money goes out, you record an expense. Easy. Then you have the mercantile basis. This one's all about timing. You record income the moment you earn it, like when you send an invoice, not necessarily when you get the cash. Clause 13A is just about stating which of these two methods your business actually uses. So the first couple of subclauses are pretty straightforward. Clause 13A asks, which method are you using? And 13B follows up with, is this the same method you used last year? This brings us to the absolute golden rule in accounting: consistency. The tax authorities really care about this because it ensures a fair apples-to-apples comparison from one year to the next. It stops people from, shifting profits around just by changing how they account for things. But what if you have a totally valid reason to change your method? I mean, businesses evolve, right? Well, you absolutely can change it, but you've got to report it. And the way you report that change is super specific. So if you did switch things up, Clause 13C kicks in with two mandatory steps. First, you have to describe the change in plain English, something like, the business moved from a cash basis to a mercantile basis. Simple enough. But the second step is the really critical one. You have to quantify the impact. Did this change make your profit go up or down, and by exactly how much? No wiggle room here. Transparency is key. All right, now we get to the part of Clause 13 that trips a lot of people up. This is where we have to talk about something called Income Computation and Disclosure Standards, or ICDS for short. This is where things can get a little complex if you're not careful. So what exactly is ICDS? Look, if you remember just one thing from this section, make it this. ICDS is not an accounting system. You do not use it for your day-to-day bookkeeping. The ICAI guidance is super clear on this. These standards only come into play at the end of the year for one single purpose: calculating your final taxable income for the government. That's it. This here shows the difference perfectly. The best way to think about it is like this. Your regular books of account, that's your company's native language. The goal is to show a true and fair picture of what's going on. But ICDS, that's the official tax dialect the law says you have to speak when you file your return. It's just a translation layer that standardizes how certain things are treated for tax, and it only applies if you're using the mercantile system. So how do you actually report this stuff? Thankfully, it's a pretty clear three-step workflow. First, under Clause 13D, you just answer a yes or no question. Do your profits need any adjustment to line up with ICDS? If the answer is yes, you go to Step 2, Clause 13E, where you quantify the impact. You show the exact rupee amount of the increase or decrease for each standard. And finally, Step 3, Clause 13F, is where you provide any other disclosures that are required. And here's what that second step, the quantification part, actually looks like in practice. It's not just some random number, it's a detailed breakdown. As you can see, you have to report the specific impact of each and every ICDS that applies, whether it's for how you value inventory, recognize revenue from contracts, or deal with borrowing costs. This table gives the tax authorities a crystal clear map of every adjustment you've made.
Okay, so we've covered the what and the why. Now let's get down to the how. This section is all about turning everything we've talked about into a practical checklist for both business owners and their CAs. As you can see, getting this right is a team sport. If you're the business owner, your job is to deliver clean, accurate information. Tell your CA your accounting method, make sure you flag any changes, and, this is a big one, you need to prepare the draft ICDS calculations. Now, for all the chartered accountants watching, your job is to be the expert verifier. You verify the method, you quantify the financial impact of any changes, and you carefully review those ICDS numbers that management gives you.
And hey, this isn't just a friendly suggestion, it's a professional standard. The ICAI's own guidance note is crystal clear. It literally says the tax auditor should obtain the draft computation from management. This is so important because it establishes that the primary responsibility for creating these numbers lies with the business itself. The auditor's role is to check that work, and they should even mention in their report that they relied on the draft provided by the company.
So let's boil this all down. What are the key takeaways? 1. Clarity is king. The whole point of Clause 13 is to make your accounting methods transparent. 2. Changes have real consequences. You must always put a number on the impact. 3. ICDS is for tax calculations only, not for your day-to-day books. And 4, teamwork makes the dream work. This is a shared responsibility. At the end of the day, getting Clause 13 right is about so much more than just ticking a box to avoid a penalty. It's about building a solid, transparent financial reporting process. It builds trust with the tax department, it gives management real clarity, and it just establishes a strong foundation of financial integrity for your entire business. And that really leaves us with one final question to think about. Do you see your tax reporting as just another chore you have to get through every year? Or do you see it as a powerful tool to bring more clarity and strength to your business? The way you answer that can make all the difference. Thanks for joining this explainer.